This is level 2 of the CFA program, topic 4, financial reporting and analysis, and the reading on multinational operations. As you look through the learning outcome statements, I want you to think of two things. First of all, the CFA Institute is probably not asking us to be accountants. Rather, it is asking us to think like accountants so that we can use accounting data and accounting information too. And here's the second part of this. The CFA Institute clearly is asking us to think like financial analysts. So that's the second part, that we want to try to use accounting stuff so that we can become more effective and more efficient financial analysts. Let's go ahead and remind ourselves what we did back in level 1, foreign currency risk through transactions and investing. Of course, look at all the names of those companies. You should know probably every one of those. The one that stood out to me just from an historical standpoint, Coca-Cola. Remember back in, I don't know what year it was, 1880 or so, John Pemberton woke up one day and came up with this formula for Coca-Cola, for this new soda pop. I can't imagine that he envisioned that one day, what are we, 140 years later or whatever, imagining that Coca-Cola gets the overwhelming majority of its total revenues and cash flows from outside its Atlanta headquarters, from outside the United States. All right, so let's go ahead and start with this first simple LOS that sounds an awful lot like this is probably in accounting books all over the world. All right, so distinguish among presentation currency. So that's the currency in which the parent prepares its financial statements. That makes sense. Functional currency, two parts here. Primary activity of the company, and also that functional currency is determined by management. And as we'll see in a later slide, this is probably going to show up in some kind of a disclosure. And then the local currency is the currency in which of the country in which the company operates. So of course, you've got a company like Coca-Cola, headquarters in Atlanta in the United States, and probably has operations in, I don't know, can I say hundreds of countries out there? So you think about all of the different currencies and risk to which Coca-Cola is exposed. So look at the bottom grayed box down there. Local currency equals the functional currency equals the presentation currency. However, functional currency of the subsidiary is probably not the presentation and the functional currency of the parent. Here's just a quick slide, an illustration about this currency risk that I referred to just a few moments ago. The reading calls it foreign currency transaction exposure, risk that the exchange rate fluctuates before the payment obligation is settled. And that, of course, it holds true whether we have an accounts payable or an accounts receivable. And what do we know about exchange rates, right? These are the price of currencies. And so they operate just like the price of a share of stock, just like the price of a bond, just like the price of a futures contract, in that they fluctuate and they change every day, maybe even every minute of every day. Let's take a look at just a really quick example. We have two companies here. Company A sells goods worth 100,000 Indian rupees. Credit terms 30 days. Boy, that's pretty generous, right? A's functional and presentation currency is the Australian dollar. And there's the exchange rate in red. 1 rupee is 0.018 Australian dollars. And then on the payment date, the Australian dollar has depreciated just a little bit, right? It used to take 18 to buy 1 rupee, now it takes 19. So the Australian dollar has depreciated a little bit. And so here's the question that relates to the LOS. Go ahead and calculate the foreign exchange gain or loss. So let's take a quick look at the table over here. So the description of the item, there we go, 100,000 rupees, that stays constant, right? Foreign exchange rate on transaction date, there's the 18. FX rate on the receipt date, there's the 19. And so all we're going to do is multiply the 100,000 rupees by the Australian dollar per rupee. So we get 1,800 Australian dollars on the date of the transaction. However, when we receive it, we get 1,900, did I say dollars? We get 1,800 Australian dollars on the transaction date, and then we get 1,900 Australian dollars on the receipt date. So there's the foreign exchange gain. So look at the bottom there. Company A recognizes the 100 Australian dollar gain on its income statement. And as we'll see in a few minutes, there's some kind of wiggle room, so to speak, of where it can show up on the income statement. As long as it shows up on the income statement, the accounting bodies, not that they really don't care where you put it, but they have two good places to put it. But let's take a look at a second example in which we have a relevant timeline in which, here, let me just go back here quickly. We didn't really have any dates here. We had a transaction date and a payment date. But now in this example, let's suppose that there's an important date in between those two. So we have the transaction date. So look in the at the table at the bottom. So there's our receivable of 1,800 Australian dollars, and then go all the way over to the far right. There's the payment receipt date of the 1,900 Australian dollars. But what happens if there's a balance sheet date in between those two? All right, so look at the top, example 2. So the transaction date, May of year 1, payment date, July of year 2, because the company has its fiscal year ending in June. So the end of June, we've got to put together these financial statements, and we need to figure out what is going to happen on June 30th. And of course, we need an exchange rate on June 30th, and there it is, 0.02. And so note what happens here. So the transaction date to the balance sheet date, we have a gain of 200 Australian dollars, right? The 1,800 over to the 2,000. But then after the balance sheet date, then the currency moves against us, so we get back to that original 1,900. So note, what do we have here? So if we went back here, we have the 100 Australian dollars as our gain during that time period. And of course, the big picture, this holds true in this example. However, on the balance sheet date, there's a gain of 200 Australian dollars. Which is followed up by a loss. And so there's the net gain over that time period of the 100. So that 100 down in the bottom right in the blue shaded region is the same as that 100 right there. Now, this is what I was telling you just a moment ago. Look at the second teardrop point under both the international rules and U.S. rules. No mention of whether the gains or losses need to be treated as part of operating income or non-operating income. And so the company can decide where it wants to put it. Now, this is where I go back to what I was saying to you at the beginning in those LOSs, is that, the accountants make those decisions, right? Operating or non-operating. But as good financial analysts, we need to make a comparison between and among a bunch of firms. And so if one firm is putting this in operating, another firm is putting it in non-operating, well, some of those ratios are probably going to be a little bit off, and they may be skewed, and they might lead us to think, whoa, this one company is doing way better than this other company, but it's only because they're putting it in one place rather than another place. It's like a professional golfer. These golfers, they play 72 holes, right, in a tournament if they make the cut. And let's suppose that we know that a golfer is going to make a triple bogey on one hole. And so where would that triple bogey most likely occur? I mean, right, you add up the scores for 72 holes, and then you get the score for those 4 rounds of golf. But if it happens on the very last hole, the 72nd hole, then that golfer is probably not going to be too happy about it. So it does matter, and we need to make sure whether this transaction gain or loss goes on the very last hole or somewhere early in the early rounds. Of course, in the whole scheme of things, the score adds up to be the score, and gains and losses will add up to be whatever they are, but we need to make sure that we're aware of those. There's probably a good table down there at the bottom. Take a picture of this and just consult it a couple of times before you go into the exam. What are we doing? Comparing exports and imports. What we need to do is try to figure out if we're exporting or we're importing, whether or not this helps or hurts us with accounts receivables and accounts payables. And so the description there's our risk, exposure, right? And then exposure, if we have the export or the import, receivable or the payable. And then over here, we need to concern ourselves whether that foreign currency strengthens or weakens. And so this is how I always tell my students this, and I use Coca-Cola as an example. I say, look, Coca-Cola benefits. They get lots and lots of cash flows, right? And so those cash flows, cash flows show up at the bottom, but somewhere at the top there's revenues, and so that then incurs an accounts receivable, right? So I tell my students that, look, Coca-Cola benefits when the US dollar depreciates, because when it converts an appreciating currency, then it converts those into lots and lots of the US dollar, which is depreciating. So it shows lots of US dollar cash flows. And so that's what we're showing over in that far right column. If the foreign currency strengthens, that must mean the domestic currency weakens, and that's going to give us an FX gain. Here's that slide I was telling you about regarding disclosure. So we can find these in the management discussion and analysis. We can also find them in the notes. A little bit of difference between the two governing bodies. Amount of exchange gains or losses is recognized in profit and loss. However, for U.S. GAAP, the disclosure, the aggregate gain or loss has to be determined for the net income for that period. Now remember, these are just disclosure items. Notice that fourth teardrop point. Neither standard requires disclosure of the line item in which the gains and losses are located. And I have an example showing you that here in just a few minutes. Sometimes these companies don't disclose it because they are immaterial. I think this is a really great exam question. Immateriality may be due to a couple of things. Hedging. If you go read the notes to Coca-Cola, which I just recently did for one of my MBA classes, there's a giant paragraph in there about their use of forward contracts and option contracts. So if we're hedging lots of this exposure, then those foreign exchange gains and losses are probably going to be minimal. Of course, if there's limited transactions, if there is a stable exchange rate, if the exchange rate goes like this, well, then there's probably not going to be any gains or losses. And then offsetting transactions, let me just go back here. Quickly, look in the middle column. If our accounts receivable are identical to our accounts payable in the same foreign currency, then we probably don't have a whole lot to worry about. So this is a good slide here to know for disclosures. All right, how about some conceptual issues here? Remember, I'm a big picture dude, so let's think about this. When translating foreign currency financial statements into the parent's presentation currency, we need to ask ourselves the question, what exchange rate should be used for each item? I mean, aren't you tempted to just say, you know what, if the balance sheet date is June 30th, like it was in that previous example of ours, then let's just use the spot rate or the market rate of exchange on June 30th. And if you take a deep breath and try to set yourself back and maybe set yourself to the side and think like an accountant might say, well, that spot rate of exchange is probably relevant for some accounts, like maybe cash, right? But it's probably not relevant for other accounts, like, maybe a building that we bought 100 years ago. We probably don't want to change it at that spot rate. So look at that bottom diamond point. What is the translation adjustment that we need to make? All right, so let's go ahead and take a look at another just quick example here. So here we are back in the Australian dollar. We own 100% of Company B that keeps its financial statements in the Indian rupee. So there's 500,000 rupees. There's the exchange rate, the same one that we had before, the 018. And so how are we going to put this on our financial statement? So there's our sales. There's the 500,000 rupees. There's the exchange rate on June 30th. And so we're going to recognize that sales of 9,000 Australian dollars from its subsidiary. Now, let me just take a deep breath and just remind you that it probably makes some level of importance that we own 100% of that company. And so if we only own 90% of that company, probably we got to do a whole bunch of other things. But that's why we have friends who are accountants and they can tell us how to deal with all that. All right, this is what I was saying just a moment ago. So we can do this one of two ways. We can translate all the assets and liabilities at the spot exchange rate, or we can differentiate between monetary items, which are things like cash and accounts receivable and accounts payable, and non-monetary items, which are things like that building and maybe a piece of land and intangibles, like a copyright or something like that. Now let me go back to the international board and the US board, that they both require that these transaction gains or losses that show up somewhere on the income statement, even if those are not realized. So they're going to show up either as an other operating income or expense or a non-operating income or expense. And so this is my thought about that. So you get, go back to that first example. What did we have? We had 100 of those Australian dollars. Where do you think that belongs? Does it belong in operations? And you could probably get away with saying, I'm not comfortable putting it in operations, but it's other operating income because it's related to our accounts payable or our accounts receivable, with our sales up there at the top of the income statement. So we can make a case for putting it in other operating income, but we can also make a case saying something like, when I do my income from operations, I don't want it to include something over which I have no control. Of course we can use forward contracts and option contracts and futures contracts and swap contracts to hedge our foreign exposure, but that's kind of financing stuff, right? So my personal preference would be to put it into non-operating income, but again, different people have different kind of thought processes. So it doesn't matter where it goes on the income statement, but it's probably going to go in one of those two places. So let's take a look at an example. Here we are. Peach Company operates in Ontario and exports its peaches to U.S. markets. And as I was creating this example, I couldn't help but think of one of my favorite Seinfeld episodes. Think of these as the Mackinac peaches. So the people in the United States, Kramer and Newman, they're buying tons and tons of these Mackinac peaches. Boy, that's a super funny episode, but it's super silly too. All right, so we're exposed to currency risk. There's the transaction exposure term that's used in the reading. And let's suppose that we have a transaction gain of 11,000 Canadian dollars. And that's analogous to the 100 Australian dollars that we had in that previous example. Some financial information from this peach company. So there's 180 revenues, 120 cost of goods sold, other operating expenses 20, and non-operating expenses 5. So the question then becomes, let's go ahead and put together an income statement when we throw that 11,000 Canadian dollar gain in the other operating income, or if we throw it in the non-operating income, and let's see what happens. And in particular, let's see what happens to a couple of important ratios. All right, so you get the sense here, in this example, we're thinking like a financial analyst. All right, let's treat this foreign exchange gain as an other operating income or expense. So here's a super simple income statement. So we'll start with the 180, subtract out the 120. That gives us gross profit of 60. And then in other net, notice we put the word net in there, net operating expenses. So what did I have over here? There was other 20. And our gain was 11, so 20 minus 11. So there's the 9,000 in net operating expenses. That gives us operating profit of 51, take out the 5. So there's our net profit of 46,000 Canadian dollars. Now look at the bottom table. We have a gross profit margin of 33%, net profit margin of 26%, and then an operating profit margin of 28%. And notice that we bolded that in red because that's going to be the big difference when we look at the next slide. Let's go ahead and do that. Let's treat this foreign exchange gain as a non-operating income. So very simply and quickly, let's go through this again. 180 minus 120, there's our gross profit of 60. And there's our other net operating expenses, which now is just the 20, right? Just the 20. Take that away from 60, that gives us an operating profit of 40. But then our net non-operating expenses, this is going to be a plus 6 because we had the 5 and the gain, we got to add that. So 5 minus 11, that's a minus, but we have to plus it because we're adding a negative, so that gets us to the 46,000 of net profit. So let me toggle back and forth here real quickly. So net profit there is 46, net profit here is 46. And so this is why the International Board and the US Board are saying, you know what, in the end, it's still 46,000 Canadian dollars. Doesn't really matter where you put it. However, note that gross profit margin and net profit margin, here I'll go back again, 33 and 26%, they're still the same, but now the operating profit margin is only 22%. So there it's 28 when we treat it as up in the other operating income, but when we put it down into kind of, what did I call this earlier, like a financing thing, we put it into non-operating income or expense, that profit margin drops to 22%. So that sounds to me like a really, really awesome exam question in which you could be asked one of two things, maybe even both of them. Hey, here's something, compute the operating profit margin, or the institute could give you this top table and this top table and say, calculate the operating profit margin under both cases and explain why they're different. All right, how about moving on to another LOS that sounds an awful lot like this, shows up in every accounting book out there, current rate method and the temporal method. All right, so we need to make sure that before we do this, we need to make sure that we're aware of what is the functional currency of the entity. So here's a list, and this is taken right out of the reading. So the functional currency is the currency that is probably going to affect sales prices of goods and services, that influences the whole cost structure from which the funds are generated, regulations, and receivables and operating activities are retained. That doesn't sound like a great way to ask an exam question, although you could come up with a simple one, and that's just probably something that you guys would do okay on. All right, so let's go ahead and start with this current rate method. So this is going to be used when the functional currency does not equal the parent's presentation currency. All assets and liabilities translated at the current spot rate of exchange. Okay, so current rate method, current exchange rate. That makes perfect sense. However, when you get over to the right-hand side of the balance sheet, in the equity, you're probably going to not want to exchange those at the current spot rate because when the shares of stock were issued, or when you had some dividends, or right, let's go ahead and do that at the historical exchange rate. And then over on the income statement, we're going to do this at the average exchange rate. Temporal method, however, is going to be used when functional currency and the presentation currency are identical. So now we're dividing these into monetary and non-monetary items. So monetary items on the left and the right-hand side of the balance sheet, that's going to be current exchange rate. Non-monetary items are going to be exchanged at historical rates. Equity and dividends, historical exchange rates. And then over on the income statement, we're going to either use the average or the historical rate. And that should make perfect sense there. So let's go ahead and take a look at an example. All right, so here we have following financial statements of a foreign subsidiary of an Australian-based company, December 31st. So there's a bunch of balance sheet items. There's a bunch of income state items, and there's exchange rate information. So look at this and absorb it, right? So when you get one of these vignettes, I imagine that you're going to have, a couple of paragraphs and then balance sheet, income statement, and exchange rate information. So this is going to jump off at the page, and if you look at it and you try to process it all at one time, you might get overwhelmed. So the goal is never to be overwhelmed when you're reading one of these vignettes. All right, so let's go ahead and use the temporal method. Of course, isn't that what we said just a few moments ago, right? All right, so what are we going to do? Look at the diamond points at the top. So we're going to use the current rate, which is the 0.03 for our monetary items. We're going to use the weighted average to translate inventory, historical rate for fixed assets, depreciation, and common stock. All right, so let's stop right there. Let's look at just those first 3 diamond points, and then let's go down to the balance sheet. All right, so we have all that stuff under 2020, right? That was all given to us. And there are the relevant exchange rates. And so you can envision a table like this, and you might have to construct a table like this and fill in the blanks, or you may have to just kind of do it longhand in the margins or in the space provided to you. So there are the relevant exchange rates in that middle column, and we just reference those that are provided to us above. So all we're going to do is take the 157, multiply that by the 0.03. So there we get 4.71, and we do that all the way down, right? And so we have total assets of 13.83. So that should be fairly straightforward, that translation. But then notice that we put the arrow in there. So let's go ahead and take that 1383 and immediately put it at the bottom, because of course we know that assets equals liabilities plus equity. So then we translate the accounts payable, translate the long-term debt, translate the common stock over at the, what are those numbers? 297, 591, and 244. And then what we have to do is we need to plug that in, right? That 251. So go ahead and look up at the top, that 4th diamond point. Retained earnings is equal to the 1383, which is total assets, or in this case, total liabilities plus equity, minus right, the accounts payable, minus the long-term debt, minus the common stock, and that gets us the 251. So that 251 is a plug figure, so that the 1383 equals the 1383, and then that 251 then can go somewhere else, right? We'll talk about that in just a second. Now, how about if we do this over on the income statement? And so at the top, what are those top 4 diamond points? I go ahead and list the average rate. There's the weighted average. There's the historical rate, and then there's the rate on whatever date in September those dividends were paid. All right, so let's go ahead and do those. Take the sales and the cost of goods sold. So we do all that stuff on the right-hand side, and we get the $2.88. All right, so what we need to do then, now remember, the 09, the 279, the 28, those things aren't there, right? Once we bring those translated figures down, so let's immediately go down and put that 251 from the balance sheet. Here, let me go over here. There's that 251. So we're going to put it right there on the balance sheet, because we know that has to be retained earnings. So let's go ahead and start with that 251, and let's go ahead and take out the 288. And let's go ahead and add in the dividends of 28, and that gets us the translation loss of 0.09. And notice we put it in red, both in the table and then back up at the top. So I would be prepared to go ahead and put together, using this temporal method, the balance sheet and the income statement. And then, of course, the next question is, well, let's suppose that we use the current rate method. And so this is what we're going to do when the functional currency of the subsidiary is not the Australian dollar. And so what are we doing? We're going to use the average rate for all the items except for dividends. All right, so there's the 0.25. So we do all that stuff there, and we get that retained earnings down at the bottom of 247. And then we throw that over into retained earnings on the balance sheet, and we translate them all at the spot rate, right? There's that 03, all with the exception of the 0.02 for common stock, and you do something super similar that we did back under the temporal method. Now, this is what I was saying earlier, effects of translation methods on the financial ratios. All right, so if we're considering just pure balance sheet and income statement ratios, meaning that both numerator and denominator come from both the balance sheet or both the income statement, these ratios are not going to be impacted at all if we use the current rate method. However, under the temporal method, those ratios, and there's a list of a couple of them there, they probably will be different. If we take something like inventory turnover, where we have inventory from the balance sheet and revenues from the or cost of goods sold, however you're defining inventory turnover from the income statement, well, then these mixed ratios, they're probably going to vary using that current rate method. However, look at that fourth teardrop point. All ratios differ from the original ratios under the temporal method. All right, so that's an easy one to remember, right? But the question then becomes, how do they differ? All right, here's a couple of good questions comparing the ratio effects of the temporal method and the current rate methods. All right, so let's ask these questions, right? Is the local currency appreciating or depreciating? Which exchange rate to use in converting the numerator and denominator under both methods? And then will the ratio increase, decrease, or remain unchanged based on the direction of change in the numerator and the denominator? So I think this should be a relatively straightforward process. And so if you get to this question on the exam, just ask these three questions. Go ahead and write the ratio down, put a numerator and a denominator, try to figure out which exchange rate you're using, right? Especially for the mixed ones, because you might be using two different ones. And then say, okay, what's going to happen to this ratio? And it's just a matter of saying, okay, the numerator is going to increase or decrease, and the denominator is going to increase or decrease. And so this is tedious. I mean, there's no doubt that, you got to do this step, and then this step, but you ought to be able to come up with the correct answer. Now, here's a great table for you to memorize. Take a picture of this one here, carry it around in your phone, like I said to you earlier. But I think this is one of those examples where it pays to memorize the exceptions to the rules. So note that there's a lot of the word increase in these rows and columns, but note decrease is only down there on the bottom left under net income and total equity. So it's probably best just to memorize the exceptions, and then you know that the rest of them are the opposite. All right, how about moving to this LOS with hyperinflationary economies? So the first thing we need to do is probably define a hyperinflationary economy. And so the two accounting bodies probably don't differ by too much, although if you take a look at the reading, they sound a little bit different, but I'm guessing that in practice they're probably not, mostly because they use the word cumulative. So, when you first read it, you say greater than 100%. You think, okay, yeah, sure, that sounds like hyperinflationary, but that's really not what it means. That cumulative 3-year inflation rate exceeds or is around 100%. So if you do regular old time value of money stuff and you backtrack, right, if you decompound 100% inflation over 3 years, you get about, 26% annual rate. So that's important to know, that if a country is experiencing 26 or 33 or 40%, that's probably hyperinflationary. All right, how about restating the income statement and the balance sheet? All right, let's start over on the balance sheet. Monetary assets and liabilities are not restated as they are already expressed in the currency units at the current date, right? The non-monetary assets and liabilities have to be adjusted for changes in general purchasing power. So we're reflecting inflation there. In addition, all of the stockholders' equity have to be adjusted for changes in inflation. And then you're going to do another plug like we did earlier with retained earnings. Over on the income statement, all these items are adjusted for changes in that general purchasing power. So let's go ahead and work through a quick example here. U.S. company establishes a subsidiary in a different country. January, this country hyperinflationary. U.S. company sends $500 US to buy a piece of property, right? So let's consider the following exchange rates. No other assets and liabilities. All right, so notice we've got January 1st, and then we have year ends, right? December of 2018, 2019, and 2020. There are the exchange rates, so that's 245 foreign currency units per US dollar, and there's inflation rate. So look, if you just look at 40 and 76 and 55, you might think, wait a minute, that's not 100%. But these are annual rates, and so if you compound them out, they're way, way above 100%. So I can't imagine the Institute would give you something in which it turns out to be 95% over 3 years, and you'd have to scratch your head and say, okay, is that hyperinflationary? I mean, surely 95%. It sounds hyperinflationary to me, but then again, I'm not an accountant. All right, so let's go ahead and do this. Original cost in the foreign currency. So I'm gonna get my financial calculator out here. So you do the same. I want you to do a couple of calculations with me. All right, so all we have to do, well, let's go back to this one here, right? So we do the 500, right? So put that in your calculator. So 500 and then the 245. So you multiply that. So that gets us our restated carrying value of that 500 US dollars. So that's 122,500 of the foreign currency units, right? So that should make perfect sense. So the question then becomes, how do we restate these as we move through time? All right, you ready for this? So you have the 122,500 in your register, and we're going to compound this out at the inflation rate. So all you need to do is multiply by 1 plus the rate of inflation. So just do 1.4 times. So you should get the 171,500, and then do the 1.76, and you should get the 301,840, and then do the 1.55, and you should get the 467. All right, so going from the 122,500 all the way to 467,452, we're just compounding that out at the rate of inflation. All right, now this is what I want you to do. You ready for this? So the current exchange rate, remember, this is in foreign currency units per US dollar, right? So I want you to do this. So put this in your calculator. I want you to figure out the rate of change in the US dollar. So let's do this. You ready? 270, hit enter, and then 245 divide, and then 1 minus. I'm using my 12C. All right, so what do you get? You get 10.2%. So think about this. The exchange rate adjusted by just 10%, but the inflation rate was 40%. So we're going to have probably some massive annual translation gain or loss. So let's go ahead and do the math. All right, so let's do what are we doing? We're going to put the 171,500 back into our register, and then the 270 divide, that gives me 635. So there's my translated amount. And so notice the difference between the 635 and the 500. There's our annual translation gain of 135. So that's a big number because the inflation rate is 40%, but the currency only changed value by about 10%. So you see why the Institute is so interested in this hyperinflationary environment, because it's going to result in massive translation gains or losses. At least it has the potential. All right, now you ready for the next one? So this is what I want you to look at, the current exchange rate. So I want you to do 480 in your calculator and then divide that by 270. And then do the 1 minus. So what do you have in your register? 77%, right? So the exchange rate changed by about 77%. How about if I round down? 76%. Inflation changed by 76%. So look over there, annual translation loss. Boy, it's only 6, right? So it's a teeny amount. So if inflation mirrors the change in the value of the currency, then that translation gain or loss is probably going to be close to 0. Oh my gosh. Didn't we study back in level 1, and aren't we going to study sometime in level 2, interest rate parity, that inflation and interest rates and exchange rates, they have to move so that those two rates are pretty close together. Now, of course, that happens in the long run. Interest rate parity doesn't hold in the short term. All right, so I think that was an important little exercise there so that you can calculate that translated amount, so in that US dollar column, so that you can get the annual translation gain or loss, but then understanding the fundamentals behind when you're going to have a big gain or a big loss. Now, if we do this under US GAAP, then we're just going to have the historical exchange rate at 245. There we go. So those numbers are going to be identical under US. So back here, I think I said this, but I may not have. So this table here is under the international standards. So this is under US GAAP here. So, the great question would be, oh my gosh, let's just beg for this one rather than this one. This is hard work. This one doesn't seem to be nearly as hard. All right, how about moving on to one of those final LOSs about the effective tax rate? So all we're going to do is take the tax expense and divide it by the pre-tax accounting profits. Now, of course, this is a result of the simple fact that companies like Coca-Cola, who have, hundreds of operations, they got different tax rates, different tax laws. Who can keep track of all this stuff but a whole team of tax accountants? But I think the most likely exam question shows up at the bottom there. The effective tax rate for foreign operations can vary due to changes in tax rates. I mean, that's an obvious notion, but changes in the mix of profits from different countries. Here we are back to thinking like a good financial analyst with this LOS. How changes in the components of sales affect the sustainability of sales growth? Let's go back to John Pemberton, right? In 1880, there's no way that he thought that Coca-Cola was going to spread out all over the world. But then once, and remember that's somewhere around 1900, I think he sold all of the formulas for Coca-Cola soft drink. But the idea is let's grow. So we're trying to grow outside of Atlanta, right? And we grow inside of the United States, and then we're trying to grow in Canada and Mexico and all other places. So sustainable growth. So this is a tremendously important concept that we first learned back with the Myron-Gordon growth model. Remember, we subtract G in that denominator, and that's always the sustainable growth. So here we're trying to, kind of look at this from a global perspective. Sustainable growth for a multinational depends on things like volume, price. So price depends on things like, branding. And then, of course, the exchange rates that are going to occur as they fluctuate over time, but more importantly, the presentation currency and then the currency in which the sales are made. Growth in sales due to volume or price changes is more sustainable. I love that second diamond point because that sounds an awful lot like a great exam question or the correct answer to an exam question. Of course, if the exchange rate moves in your favor for 3 months or 6 months, or hey, how about 2 years or 4 years or 5 years, then you're going to look like you're a super skilled executive. But if your branding, if the quality of your asset, remember we learned all this stuff back from in Modigliani and Miller with their capital structure argument. All right, so sustainability comes from branding. It comes from the quality of the asset, the quality of the product line, being able to make something for pennies and sell it for dollars rather than just favorable exchange rate movements. Now, we said this earlier here, disclosures about the effects are probably included in the MD&A. Organic sales growth is the growth in sales excluding the effects of all this other stuff. And so as a good financial analyst, this is what we want. We want organic sales growth. Think about this in the context of Modigliani and Miller, who taught us that the value of the firm depends on the quality of that product line and the weighted average cost of capital, right? And now, of course, in their model back in 1958, they assumed a no-growth firm. But of course, firms grow, and organic sales comes from branding. And so look at this, quick little formula there. Net sales growth is equal to organic sales growth plus, now there's a plus minus sign there because we can acquire, we can divest, and we're going to have foreign exchange losses. And so note the bottom diamond point there. Foreign currency translation loss reduces net sales growth. So let's think about what this means from an exam question and from good financial analyst framework, is that we are going to be certainly delighted if the exchange rate moves in our favor, right? If we have a good product line and we're selling it in foreign countries, like the Mackinac peach, if we're selling this and Kramer and Newman are buying this and we're all buying the Mackinac peach, that's awesome. And if the exchange rate moves in our favor, then our cash flows are going to look even better. But what we want is we want to make something for pennies and sell it for dollars, so that even when that currency moves against us, we still have some sales growth. And then, of course, it takes somebody with some prescience, some foresight, and guts, of course, these individuals, to use forward contracts and futures contracts and option contracts to protect ourselves against those adverse exchange rate movements. All right, how about this one here? Potentially affect the financial results. All right, so currency risk. Show the effects of changes in currency values on assets, liabilities, and future sales. I would add, I'm a Modigliani and Miller dude, I would add future sales of business, but as a good financial analyst, future cash flows of a business. How about eliminating currency risk? How can we do this? Well, let's go ahead and skip to the second one, short-term solutions, so we can hedge currency risks in the financial markets with what I just was saying earlier. I mean, you look at some of these disclosures and notes and financial statements. I mean, all international companies use forward contracts at some point or another during the course of the year, but not the majority of them use options or use futures contracts or swaps. So short-term solution, we can hedge that. Now, remember, there's a foreign currency swap that is more longer term in nature. So let's just put that on the shelf, and we'll talk about that someday when we do derivatives. But we can also create a natural hedge by closely matching the currency of expenses and the currency of sales. So this is, I hate to use this example. I don't want to say it's identical, but in my mind it is. From a big picture standpoint, this is just like matching the duration of the assets to the duration of the liability. Now that's an investment kind of a thing. Here, this is more of okay, what do we make and where do we make it and what's our supply chain look like? But you can create a natural hedge. I like this bottom arrow point, disclosures related to major sources of foreign currency risk. So I love performing sensitivity analysis. I've said this to you guys multiple times. Put this in a gigantic Excel spreadsheet and do some sensitivity analysis. Change the exchange rates from, whatever you think they're going to be to something a little bit less, to something a little bit more, and then redo whatever it is that we're trying to do. In this case, let's go ahead and calculate some kind of a profit margin. And then, of course, we can extend that to cash flow at risk models. Boy, how much did we love value at risk? We love cash flow at risk as well. And that takes us through these learning outcome statements. So in summary, we don't want to be an accountant, but we want to think like an accountant, but we want to clearly think like a good financial analyst.